In normal times, central banks rely heavily on short-term policy rates. In crisis times, normal tools can become too weak. When panic hits, financial plumbing breaks first. Funding markets freeze, liquidity disappears, banks hoard cash. Forced selling drives prices below fundamentals. At that point, a central bank can switch into emergency mode. This is where tools like quantitative easing, emergency lending facilities, and large-scale liquidity operations appear. QE is often simplified as money printing. A more precise description, the central bank buys financial assets, typically government bonds and sometimes other high-quality assets, to inject liquidity and compress yields. That does several things at once. Stabilizes bond markets, lowers long-term borrowing costs, pushes investors out the risk curve, supports asset valuations, signals policy commitment to preventing system collapse. In 2008, these actions were framed as preventing financial implosion. In 2020, they were deployed with extraordinary speed to stop a liquidity shock from turning into a full depression dynamic. But every emergency intervention has second-order effects. If liquidity is abundant for long periods, asset prices can disconnect from wage growth. Those who already own assets often recover first and fastest. Those with little or no assets experience the recovery mainly through delayed labor market improvements and higher living costs later. This is how policy aimed at system stabilization can also intensify distribution gaps, not by intention, by transmission order. Money reaches Wall Street channels before Main Street wages.